Hi, my lovely students. Welcome to my macroeconomics courses. Today, I'm going to conduct a presentation about the macroeconomic policy, quick guide to macroeconomic policies through fiscal and monetary policy. And first of all, I want to apologize if you cannot catch any details from the presentations. If you have any questions, you can just comment to me, and I can provide you a feedback on your questions. So, guys, today we are going, as I explained you, we are going to conduct a presentation about the macroeconomic policy, mainly the fiscal and the monetary policy. Let me just go to the what we will cover today, what we will learn today. And okay, so we are going to cover today this course outline and why have any macroeconomic policies, how can we classify macro policy directions, and then we are going to talk about fiscal policy, and then go to monetary policy, and then we will ending up with the conclusion and the wrap up. So, guys, first of all, let's go to why have any macroeconomic policies. Why do we need that macroeconomic policies in the first place? So business cycles have occurred for centuries, yeah, and they generally began back in the 19th century, and they have occurred all the way to the most recent global financial crisis and Great Recession. Yeah, so between the every 6, 7, 8 years, we often go through a boom and a bust. Yeah, and this have repeating swings through the prosperity, recession, depression, and recovery. Now we talk about the boom and the bust cycles. The economic indicators are generally changes in aggregate output, employment, as you can see in the slides, prices, and the national income. So um, that's like GDP, gross domestic products, and unemployment rate, and the inflation rate, and gross national incomes, or um, or wages, and business profits, and so forth. So we have had this repeating periods of booms and boosts, and so our society and the civilizations minimize have organized to minimize the impact of this disruptive volatility. And it doesn't take a lot of remember the global financial crisis and how a lot of world's population had a very difficult time adjusting to this business cycle. A lot of people lost their jobs, a lot of people lost their homes, incomes, profits were low, wage growth has been low since. Yeah. So the recovery has been slow, and that's just one example. It has been hard um, on on the people of the world. So our societies have organized, and uh, in modern times, in current times, we have designed to main institutions that aim to minimize the negative impact of business cycles. Now we have designed governments to governments regulations, like non-regulations, like government tools to help out with the business cycle. And they do also created the concept. They do um, I mean, out with the business cycle, and they do this through with the fiscal policy and with the help of government, of course, and then with the help of central banks, with the monetary policy. Yeah, they operate with the monetary policy. So, what are the goals of the macroeconomic policy? This is kind of in colloquial terms rather than the technical terms, but we just want to try to make the good one last. We want extended periods of high, stable, and ever growing prosperity. Yeah, ever growing prosperity. And on the flip side, we want to ease the difficulty, the bad sides, bad times. We want to shorten periods of recession and minimize the need for harsh and abrupt adjustments of its citizens. So, kind of, we want to have the soft landings. It's when we have to do things major and very quickly. That is very hard. That's very hard for the population to adjust, and it causes a lot of friction and unhappiness. So why do we have this macroeconomic policies? To sum up, if we come to sum up, we have them to improve the quality of life. The quality of life of citizens. A lot of people believe it's just simply about making money in business. And the economy is simply about everyone getting rich or certain people getting rich. But genesis of most macroeconomic policies, the genesis of macroeconomic policies is to improve the quality of life of all citizens. How successful they are. How successful they are. I will let you debate. But they are the aims of our today's topic. Okay. So, how can we classify macro policy directions? How we can do it? Now we are getting to some of the more technical stuff. We will either classify macro policies as expansionary or contractionary or even natural. Now, expansionary policies encourage economic growth. They try to combat deflation. As you remember, we talked about the deflation in our previous classes. They combat the deflation. They combat the deflation when the prices are falling, or disinflation if it's accelerating too quickly. And disinflation is when inflation is slowing down. Disinflation is when inflation is slowing down. When inflation is still occurring. Okay, students, when inflation is still occurring, but it's occurring at a slower rate. And we will also try and boost employment try and boost employment and national incomes through expansionary policies. Well, technically, what these policies are trying to do is increase aggregate demand in the economy. What? Aggregate demand in the economy. Let's go to contractionary. Okay, let's concentrate on contractionary. This time, let's go to contractionary. Sorry for some technical problems on this slide. Okay, it's not so much problem. This time, we are trying to slow, moderate, or stabilize economic growth. And then we could also combat rising inflation and its negative impact. Now, I'm not going to go into the specific negative impacts of rising inflation, other than saying that they are very, very pervasive. And sometimes we have to moderate employment growth. We have to stabilize wage growth, or we have to stabilize the wage growth or the inflation that is caused by wage. And it is the opposite to last time. We are trying to decrease or moderate aggregate demand in the economy. But this is an important note. Okay, keep on your keep on your mind. This is an important note. The goal is not just to kill the party. The macro policy is not trying to make less people employed or less people wealthy or slow the good times. The goal is to attack the risks of inflation and the possibly even hyperinflation, which we learned in our micro classes. Hyperinflation, and minimize the chance of an epic boost. Now, I am sure a lot of us have heard that the old saying, the bigger the boom, the bigger the boost. So if things get out of control and we have a huge boom, then we might have an even bigger boost. Yes? Which will be even harder to adjust to when the things eventually do correct. Yeah? And as I mentioned below, inflation can be very pervasive in the economy. It can destroy your wealth. It can damage your wealth. It can misallocate your resources. We have probably seen some countries, that they have had a hyperinflation, whether it is historically in Germany or in modern times in Venezuela. Yes, I told you in my previous classes where the economies really do fall apart when hyperinflation kicks in. We cannot ignore natural policy. The natural policy is a kind of like when policy setters think that we are either in a sweet spot in the economy or what is termed a Goldilocks economy. Maybe Goldilocks. I found this This is a good, the economic types where after that all the fairy tale where it's not too hot, where it's not too cold. You can search in on Google. That's in a good economy types like Goldilocks economy. You can find more information about that. That are not so cold, not so too um, hot, or we may just be an uncertain period, and the policy setters um, kind of what to wait and see before they make their next move. Um, so they may wait for a few months or few quarters, see how the economy tracks, or what previous decisions, how they impact the economy, their next move. Now, the nature of fiscal policy is when this period's deficit or surplus is equal to the last period's deficit or surplus. So there is no aggregate change in taxes. Yeah, there is not an aggregate change in taxes or expenditure. Yeah, or the balance of them. Now, the natural monetary policy is when the policy rate is equal to the natural rate. Now, the natural rate is real GDP, at the trend growth rate plus the target inflation rate. Yeah? Um, Real GDP at the trend growth rate plus the target inflation rate. And that's the formula. That's the formula for the natural rate. Yeah, maybe if you want, you can take the notes, dear lovely students. I want to emphasize again. Um, Real GDP, the natural rate formula is real GDP at the trend growth rate plus the target inflation rate, and that's the formula for the natural rate. In regards to monetary policy, so all right, um, so let's get into the policies. Okay, into the policies. What are the policy levers for the fiscal policy? That is, that's right. It's taxes and spendings. Taxes are and spendings, which is the famous phrase you probably heard of many times. Yeah, in our microeconomics courses, you learned about this spendings and the taxes, and this is of maybe interesting for you. So when we talk about the taxes, yes, dear students, so we are talking about revenue. So revenue raised by the government. Revenue raised by the government. That forms part of fiscal policy. And then they can have the direct taxes on income and the wealth. So as I mentioned before, yeah, maybe some of you guys know, in Azerbaijan we have the nine types of taxes, and actually not nine types of taxes. We have the direct and indirect taxes. Yeah, we know that we have the nine forms of taxes in Azerbaijan, and two of them, excise and value-added taxes, are the indirect taxes, and then other seven taxes are the direct taxes. Yeah, and then they can have the direct taxes on income and the wealth. And so the talking about our income taxes or our company profit taxes or even our maybe maybe simplified taxes and etc. Yeah, which we are giving the taxes to the state budget, the state budget to the directly. Um, Maybe I want to just emphasize in regards to services, and here you will find your maybe indirect taxes, the value-added taxes, maybe or your excise taxes, and etc. Okay, so other types of equation um, in regards to fiscal policy levers are the spendings. So that's an expenditure. Yeah, spending when we talk about it, that's a cost. Yeah, expenditure. Yeah, to spend. Now the governments can um, introduce transfer payments, and these are just crush payments to citizens. Yeah, to citizens to redistribute the wealth within the economy. Other than that, governments can have current spending. This is when the government pay for goods and services to fund the government itself and its services. Defense spending or health or education spending, or maybe in the United States, federal education spendings, or in European education spending. So let's concentrate with Azerbaijan. Okay, defense or health or education or state education spendings, and these are the expenditures of the government. These are your current spending categories. And finally, there is a capital spending. There is a capital spending. That's when we fund infrastructure or other long-term assets to boost the economy, productivity. I mean, they are things like governments, buildings, railroads, or other infrastructures, or maybe in the government buildings, or and etc. or other things. Yeah, or other things like airports, ports, and similar sorts of things, and other things. So it can also include more intangibles. Yeah, you remember, yeah, tangible and intangibles. So these are intangibles, including the intangible categories. Like if government invests in research and development that that could possibly lead to breakthroughs in particular technologies. But students, just remember the three main expenditure items are transfer payments, current spending, and the capital spendings. Again, I want to mention that three main expenditure items are transfer payments, okay? Please take notes, current spending, and the capital spending. Right. So please write on your copybooks, take notes. So how do we implement an expansionary? Let me go to this. How we go? How we do implement an expansionary policy? In this case, we would increase expenditure. We would increase expenditure or decrease taxes or both. Whew. What we are doing this, increasing the deficit or reducing the surplus. Okay, you understand, reducing the surplus and thus increasing economic activity. Again, what we are doing, we increase the deficit or reducing the surplus, and we and thus, of course, thus increasing the economic activity. So if the government increase the expenditure, Okay, if the government increases the expenditure, it's spending more, and this would increase the economic activity. Or if it simply, or if it simply decreases taxes while maintaining the same overall expenditure, so less money has been taken from the households and the firms. They can continue to spend, and it will not be locked up in government coffers, and will thus will also increase economic activity. Okay, economic activity. And and the opposite is for implementing contractionary policy. And you maybe um, you will decrease expenditure, or you would increase taxes, or you would do both. And you again, opposite would result. You would reduce the deficit or increase the surplus, and this would decrease the economic activity. So if the government spends less, or the government tax more without having a commensurate increase in expenditure, then that would slow down the economy, as there would be less activity. All right, so let's move on. To monetary policy. What are the policy levers? Rates. Interest rates are Interest rates are the policy levers, and the central bank influence the interest rates, often through the money supply. You remember, guys, I explained you the government intervene to the market through the two different ways. First is the budget tax policy, which we call the fiscal policy. Second one is um, money credit policy. It means that monetary policy. Yeah. So the government regulates the money circulation in the turnover through the help of taxes and through the help of monetary policy with the interest rate. And how the influence to the monetary policy? Through the help of interest rates. So influence the interest rates often through the money supply. So how are interest rates and the money supply altered? Um, so a central bank, the Central Bank of the Republic of Azerbaijan, can set a policy rate. And say this is what the banks are charged when the borrowing the central bank reserves. I remember that that's 7.25. 7.25. It means that all the commercial banks go to the central bank, get the loans with the interest rates of 7.25, and then they add their commissions and give to the consumers with the consumption credits or consumption loans, or and etc., or hypothecs or deposits, not deposits, or hypothecs, or mortgage loans, and etc. So um, private banks can often borrow the central bank reserves and at attractive rates. Of course, all the commercial banks trying to get this. I mean the reserves from the central banks with a low rate. But unfortunately, the central banks is regulating this. I mean the corridors, like um, these interest rates. And as I mentioned, that private banks always try to get this to borrow this reserves from the central banks at attractive rates. I mean that with the low rates at which they can then on lend to businesses or households or firms and or their families. and or consumers. Obviously, the higher the rate, the less attractive it will be for those banks which to borrow from the central bank reserves, and central banks can also and central banks can also um, um, central banks can also give this what I mean, how can I tell, this can change this interest rates, maybe day by day or time by time. And so as I mentioned before, this is where they buy and sell the government securities, um, for cash, and finally they can set the required reserve ratio. They can I mean that the commercial banks, they can determine how much banks need as reserves. I mean I'm sorry, not commercial banks, the central bank, they need as a reserves, and the banks need um, those reserves. They cannot lend it, and this is in turn affects the deposit expansion multiplier, which impacts aggregate demand in the economy. So so, how do we implement an expansionary monetary policy? In this case, we need to increase the money supply, and assuming a stable money demand, interest rates will decrease. And then, when the interest rates decrease, borrowing and expenditure becomes more attractive, and this should hopefully increase economic activity. Uh, and there is, I just said it, the impact is increased borrowing, and um, as a result, increased economic activity. All right, guys. So these are the technical, and it's not I mean, it's not a technical, but these are how an expansionary expansionary um, policy will be expansion policy will be implemented. Firstly, the central bank could decrease the policy rate, and they can make it easier for banks to borrow from central bank reserves, and then the central bank on lend to households and other firms. Secondly, the central bank could buy securities in an open market operations. So the central bank could hand over money to the commercial banks, yeah, to the commercial banks and the other participants, which they can then on lend. So they can, I mean that a central bank can take that piece of paper, the security, they hand over the cash to commercial banks, and the cash is on lent and the multipliers throughout the economy. And then finally, it could reduce the required reserve ratio. Central banks reduce the level of reserves need to be held by banks. Yeah. Then this excess reserves um, can be on lend. Yeah, can be on lend, and that's kind of self-explanatory. So if the banks do not need to hold 10 percentage of their 10% of their liabilities in cash, but perhaps only 5%, then that other 5% can then be to um, relent to other households and the firms. So, can we implement a contractionary monetary? Can we contractionary monetary? Um, uh, yeah, again, this is just the opposites. We will decrease the money and money supply, and assuming the stable money demand, interest rates would increase. This would supply this would increase borrowing because borrowing is now more expensive with high interest rates, and this would decrease the economic activity. And implementing it is the exact opposite to earlier. So would you increase the policy, sell the securities in open market operations, or would you increase the required reserve ratio for banks? Okay, so guys, I want to come up with a conclusion. What we learned today, we learned about that how the government regulates to the market economy, in which ways, by the help of through the help of with the fiscal policy and through the help of monetary policy. And so we also learned about that how the fiscal policy, why have any macroeconomic policy, why do we need that, and also we learned about that fiscal policy, and we learned about that our societies and civilizations always have organized to minimize the impact of the disruptive volatility. So we also learned about that what are the main goals of the macroeconomic policy and why these are implemented. So we also learned about contractionary, um, expansionary or contractionary, or either natural macroeconomic policy directions. So then we talked about fiscal, monetary policy, and the indicators of each of them. Hope you enjoyed from this courses, and please keep in touch. And if you have any questions with the fiscal and the monetary policies, please keep in touch with me by WhatsApp group or by email, and you can ask any questions. Don't hesitate, and so I will provide my feedback for you. Okay, thank you very much, dear lovely students. See you in our next classes. Bye bye. Take care.